Bitcoin's institutional FOMO phase is here, and it is sending markets higher. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, I want to talk about the strong Bitcoin market, what's going on in U.S. Treasuries, and why the U.S. Treasury market's strength is linked to Bitcoin's success over the next couple years. We'll begin with a quick refresher of our framework at the Bitcoin Layer. What we use to analyze the conditions for risk market is an index that we have created called TBL Liquidity. In TBL Liquidity, you have the banking system itself, you have the prices of treasuries, volatility of treasuries, and the US dollar. Each of these four components has an impact on the risk-taking conditions for Bitcoin and the stock market. So, for example, when bond volatility spikes, the conditions for risk decline, and we usually see a decline in risk prices. With a historic correlation between Bitcoin and the stock market, we can identify that both of these assets are indeed expected to be impacted by liquidity conditions. That means that Bitcoin is a liquidity asset. Bitcoin receives fundamental demand because it is an emerging asset. However, it also receives demand from liquidity, which we think of as new money created or the conditions to create that new money. Now, people can go check us out at thebitcoinlayer.com/subscribe if you want a more quantitative explanation for our framework. But in the meantime, what we believe is that these conditions lead to risk prices, and so we are tracking what is happening specifically in the Treasury market. What we observe is that when interest rates exhibit a lot of volatility, either on the upside or on the downside, and that it's interesting to us that of late, some of that volatility has been on the downside. It creates a condition that puts a lid on the Bitcoin price. It sends prices lower. And what we have witnessed over the last few weeks is an unwind of a lot of that bond volatility. As a result, both stocks and Bitcoin have performed very well. Because of this empirical observation, we are able to conclude that Bitcoin is in fact affected by the Treasury market. Sometimes when rates are going up and sometimes when rates are going down, these conditions of elevated volatility send Bitcoin lower. However, on the other side, when interest rates are receiving less volatility, meaning the markets are getting calmer, again, either to the upside or downside on interest rates, this is sending Bitcoin higher. So what we want to see as Bitcoin holders is calm Treasury markets. What are some of the things that can cause the Treasury market to enter choppy waters? Well, one of those times of late was the 2021 and 22 inflation wave. The second one was more recently when we saw Bitcoin fall as a result of elevated Treasury volatility. At the beginning, it was a drop in interest rates, and then it was shortly followed by a spike in Treasury yields. Now, during that entire episode, Bitcoin sold off, both first on the downside in rates and then to the upside, because rates were experiencing elevated volatility more broadly. So that volatility, it impacts credit creation, it impacts market making, and it impacts the Bitcoin price. For that reason, Treasuries and Bitcoin are linked. It's more from the volatility side, which is a condition that is put on the market basically by every risk taker and market maker that is looking to enter or leave the market. When risk takers and market makers are involved in a market and are playing very tight margins, that is a good condition. When they are stepping back and they are unsure, there are very wide margins, and those wide margins are reflected by falling asset prices, because the asset prices themselves, they can't find buyers and sellers to agree on a price. That price at which buyers and sellers want to come together, it's wide and it makes for gappy markets. So that's what we want to avoid. And yes, if Treasury yields are going up in an uncertain way, that will cause a very bad condition for Bitcoin. So what we want to see is Treasury markets exhibiting some stability. One of the ways that can happen is for debt to go up in a way that is slower than the rate at which GDP is going up and thereby the tax base. Whether or not this administration can engineer a slowdown in debt to GDP is still yet to be seen. The way that we can measure the premium that the market is charging for lending the US government money over a long time horizon is basically reflected by the yield curve. Bond market enthusiasts and the financial media will sometimes call this term premium, but term premium is a calculation that is based off of the yield curve. The yield curve is looking at what is the rate that the average investor is looking to get from the market on an overnight basis, a 2-year basis, and then compare that to the 10-year and the 30-year part of the curve. The way that the market works is that the curve prices in what the market believes the short-term rate will be at an average over that entire time horizon. Therefore, a term premium or a yield curve can be very steep if, and by steep I mean the long-term yield being much higher than the short-term yield, that steepness can be present if people believe that the rate, that is the short-term rate, will rise over time, thereby making an overnight rate reinvested overnight equivalent to locking it in for 10 or for 30 years. Now, a very steep yield curve will reflect that the market believes rates are going to rise over that time horizon. And so we can use the steepness of the yield curve to measure how much investors believe rates will rise over that time horizon. But the short end of the yield curve, reflected by overnight rates, 3-month bill yields, or even 2-year Treasury notes, these interest rates reflect where the price of money is today and over that 1 to 2 year time horizon it will be. And the price of money is dictated by the time value of money. And yes, the Fed anchors it, but we believe that the Treasury market leads that rate up and down. We have evidence of that in recent times during 2021 when the 2-year yield started spiking far before the Fed started hiking rates, then crossed back below the Fed's policy rate, giving investors a long lead time before the actual pause of interest rate hikes. And then, yes, it did lead the Fed lower as yields started to fall long before the Fed actually did cut its interest rates for the first time after it reached 5.5%. So 2-year yields lead the Fed, and that is a market-driven rate. The Fed is simply reacting to these policy rates. And the long end of the yield curve reflects where will the price of money be over that entire time horizon. And in this metric, we can measure what is that premium that the market is charging. Where do they think that interest rates are going over that time horizon? And so, if Treasury yields in the 10 to 30 year part of the curve get to 5, 6, 7%, you are talking about an epic disaster and meltdown in all of risk, because such a term premium is an expensive charge to the rest of the market as a simple result of the crowding out effect. As investors are looking for 7% yields, they don't have to go today to Treasuries to get those. They have to go into something riskier. But if yields rise to 7% in Treasuries, they might see that as an opportunity to sell their risk asset and then put it with the Treasury because they're locking in 7%. That is why a steep term premium or a steep yield curve is a charge on the rest of risk. That is why Bitcoin depends on the Treasury market for price stability, because the Treasury market, if it is going to sell off dramatically, you are going to have a condition that causes risk broadly to sell off. Stop asking how to value Bitcoin and start asking how to value everything else in terms of Bitcoin. A new report from Unchained and Strive reframes the way that we think about capital allocation and equity valuation. Repricing the economy in Bitcoin introduces a Bitcoin-denominated DCF model, discounted cash flow model, that changes how we value everything. Download the report at unchained.com/TBL. Unchained.com/TBL. Blockstream Jade Plus is the easiest, most secure way to protect your Bitcoin. Perfect for beginners and pros alike. With a sleek design, simple setup, step-by-step instructions, you'll be securing your Bitcoin in just minutes. Seamlessly pair with the Blockstream Green app on mobile or desktop for smooth onboarding. And if you want more security, Jade Plus supports multi-sig wallets with apps like Blockstream Green, Electrum, Sparrow, and Spectre. Protect your Bitcoin, sleep better, and stack harder. Use code TBL for 10% off. Go to store.blockstream.com. Use code TBL for 10% off. Do not write your seed phrase on paper. A lot of Bitcoin is lost forever, and poor seed storage techniques are a big reason why. This is why we use Stampseed, a DIY kit that enables you to hammer your seed words into titanium plates. You use professional stamping tools. These plates are heat resistant, rust resistant, and crush proof. They are compact and easy to hide, and most importantly, they will stand the test of time. Go to stampseed.com today and use code TBL to get 15% off of your order. Now, I want to bring in the corporate bond market here for a few minutes, because what we are seeing right now is a massive wave of institutional FOMO. We have been tracking institutional FOMO in this story for several months as a result of Michael Saylor's strategy implementing a Bitcoin Treasury strategy that is causing an enormous wave of capital to come into that equity. Now we have, I'm not going to call them copycats, but you have companies that have come in, looked at this strategy of allocating Treasury assets to Bitcoin and seeing the success. At the Bitcoin layer, we have been calling it a shield to against short sellers from the corporate side, because Bitcoin as a treasury asset, it can scare away these short sellers. It can really give your equity this leveraged upside play. And by leveraged, I mean that not all corporate balance sheets are funded 100% in equity. Many of them rely on debt and debt instruments. And when they are issuing those debt instruments, they're able to borrow money from the capital market and allocate to Bitcoin. A lot of that debt that is raised in the market, whether it's euro-dollar debt or onshore dollar debt, it doesn't matter. It does in many ways link itself to rates in U.S. Treasury world. And so because we have U.S. Treasury yields affecting the market borrowing conditions for corporations that are allocating to Bitcoin, the Treasury market and Bitcoin are even more linked than just from the raw liquidity standpoint. So for all these reasons, we should be watching the United States government trying to get its debt to GDP to a more manageable situation if we don't want this large term premium to be introduced into the market. Why would a term premium be introduced? Because the market doesn't want to hold 10-year debt at only a 50 basis point pickup to the front end of the curve. And if that curve goes from 50 basis points to 300 basis points, I can promise you that you're going to have money coming out of risk and locking in those 7% treasury yields. And so if we see that type of dramatic steepening, and I'm not talking about necessarily going to 7%, everything in the market happens at the margin. Right now, Bitcoin is at $105,000. We are here on Monday, May 19th, and the block height is 897,447 at this point. Bitcoin's price is $105,700. Bitcoin's price is right up against its all-time high. It's at an all-time high closing weekly candle. It's up against an all-time high daily closing candle. Bitcoin is in a good liquidity condition, even with U.S. Treasury yields right now in the 10-year part of the curve at 4.5% and the 30-year part of the curve at 5%. And so everything is at the margin. If Treasury yields in the 30-year go to 5.5%, is that going to be the marginal thing that destroys the condition for risk assets? Or is it the move from 5.5% to 6%? We don't know until we get there, but this is how we measure the market. We look at where is the move index? That is how we measure bond volatility. Well, it's fallen over the last few weeks. That means that this rise, this steepening in the yield curve, the 30-year part getting all the way up to 5%, it's not causing uncertainty to the point that market makers are stepping away from the market and causing a tight liquidity condition on risk. And they're not doing that. We don't see a spike in the move index. And so we see that show up in risk prices. What will contribute to U.S. Treasury stability over the next 5 to 10 years? Well, geopolitical stability, the willingness of foreign buyers to come in and buy U.S. Treasuries, and of course, most importantly, the debt to GDP itself not rising at an alarming rate, which will mean spending less and making sure that the U.S. economy is growing, and what will contribute to U.S. Treasury strength over the next 10 years and get interest rates to a point where they're not rising too quickly in the long end of the curve. It's going to be stable inflation and, to a large degree, stable geopolitics in a global reordering and potentially in the middle of an entire monetary reordering. As a larger theme, one of the things we're watching at the Bitcoin layer is the extreme shifts in global trade and global monetary order here in 2025. We're undergoing a rapid transformation. We're trying to keep up with it to the best of our ability. We look at the president's trip to the Middle East, securing a lot of cross-border deals, investments in the United States. We think about what is the role of U.S. Treasuries in some of those talks. And to a certain extent, what is the role of gold and or Bitcoin in any of those talks? We know that defense and Iran were at the center of them. The headlines that we got were around artificial intelligence, a lot of that type of investment, but it's implied that security talks were the main motive. It's publicly available that AI and technology sharing and technology investment was a central part of the deal. But what about U.S. Treasuries? What about the dollar? What about the fact that all of these Middle Eastern currencies are pegged to the dollar? What about the fact that the U.S. and the Middle East are two of the largest holders of gold around the world? And what about the idea that the U.S. has introduced a strategic Bitcoin reserve by executive order, and the Middle East, specifically Abu Dhabi and the United Arab Emirates, are making massive investments into Bitcoin, Bitcoin mining, Bitcoin in their sovereign wealth fund, and largely legislation that is friendly to Bitcoin? We have to think about where Bitcoin and gold are fitting into these conversations, even though we're not getting headlines about them. We look at the price to also tell us what are the demand side conditions for Bitcoin, because we can understand how liquidity affects Bitcoin. Bitcoin is a liquidity asset. We see it move up and down with Treasury volatility, but it's also an emerging technology. So the demand side is emergent for Bitcoin. And when we see its price go up, the magnitude at which it rises is a direct result of the emergent demand, not necessarily the liquidity precondition for the expansion of money and that new money to flood into Bitcoin. We have to think about both sides, liquidity and the technology, the emerging technology, or I should say emergent technology that is Bitcoin. What are some of the things that we're watching closely here? We're watching the talks between Russia and Ukraine to see how those develop and how that might affect the Treasury market. We're also watching a story about China being sensitive to U.S. warnings about Huawei. Now, if the U.S. is going to keep on with this progression toward a deal with China or a friendly progression with China, any issue that bubbles up has the ability to break confidence and to break trust. And the U.S. does appear to still be warning against Huawei technologies around the world, and that is concerning to China. So we want to watch that story very closely. And then I have one last thing here for you guys. Gold markets are cited by ECB as a risk to financial stability. This is something we covered very critically in the Bitcoin layer. People can make sure that they are subscribed at thebitcoinlayer.com/subscribe. Become a TBL Pro, get our quantitative research, get my weekly letters. And in that weekly letter, I flagged to you guys that the rise in gold's price has the short sellers in the derivatives market on watch. And if they are capitulating, meaning they have to go out and source that gold for delivery to close their short position, it could be one of the reasons that the gold price has performed so incredibly well over the last couple years. Now the ECB is citing these short positions as a threat to financial stability. This is an enormous story. It's an absolutely enormous story because we've been talking about how the Fed has warned Europe you might not get swap lines in a financial crisis. We've been talking about how the U.S. is trying to force potentially Eurodollar banks to hold U.S. Treasuries so that they can access liquidity if they need it by posting those Treasuries through their central banks at a swap window. The Fed has its own foreign repo facility. And if that is the progression, if we are in a war against the Eurodollar system, we're putting these European banks on watch. And one of the things that I believe very closely here is that if the Eurodollar system is unable to roll, meaning that it's unable to secure Eurodollars, and banks are collapsing those interbank liabilities, it is a deleveraging of the financial system offshore, and it can lead to a re-leveraging of the financial system onshore. And this does appear to be part of the current administration's agenda. We're watching it unfold. Make sure that you're subscribed to this channel where we bring you regular episodes on Bitcoin, global macroeconomics, the Treasury market, bond volatility, and our own proprietary metric TBL liquidity. And we'll catch you guys next time.